Hey guys, welcome back for another YouTube video. This is going to be our daily cryptocurrency market update video where we don't just look at the cryptocurrency market, we look at markets across the board as the crypto story is very much driven by the macro environment and landscape. And I do not believe that the environment that we are in terms of a kind of macro environment, in terms of an economical environment, is going to be very supportive of this being the bottom. And the start of the new bull market. When you look at the fact that markets are driven by money and liquidity, liquidity is becoming very expensive. We're seeing that in the repo market. We're seeing, I think, $2 trillion clogged up in the repo market in the US. And we're also seeing a real push and a run for the dollar. The dollar doing exceptionally well. We've now got other countries, starting with Europe. We had the Bank of England yesterday actually looking to up their interest rates to maybe kind of firm up their own currencies against the dollar. But I think the dollar continues to gain a bid. And we're going to be covering some really interesting things in this video. Why is the dollar important to Bitcoin? Well, what drives Bitcoin's price? Typically, the largest liquidity going into Bitcoin is the dollar. But you also have other currencies that are going for a similar thing to the dollar in terms of driving up the demand for them via making liquidity and debt more expensive. I don't think that... I think for people to expect this to be the bottom, the macro bottom for this market and this sort of bear trend is just foolish given everything that's on the table. And we're going to talk about that. We're going to be looking at a thread, from TED Talks Macro, talking about commencing in September, the Fed will withdraw up to 2.2 US dollars out of the market per minute. Bullish USD, bearish risk assets. This is where we're kind of going. We're going to look at the yield curve because you've got some insane moves taking place on the yield curve. For anybody who doesn't know what the yield curve is, and I'll just move my face out the way, the yield curve essentially is the long-term yield, which is the 10-year yield in this case, and the 2-year yield. Essentially, when you have an inverse correlation, so the people are going for the 2s instead of the 10s, you end up with a situation that essentially the yield curve inversion has predicted every single sort of crash and recession that we've had going back to the 1980s. And we've had not just a yield curve inversion, we had a rally off of it, and now we're really slamming down. The past one that we had was in 2019. This had a lot to do with the repossession, or not the repossession market, the repo market in the US. It happened as a result of them upping interest rates, which is what they're currently doing, and doing it at more of an aggressive manner. We're already at that 2.5% interest rate, Fed funds rate, which the last time we were at this level, they actually, broke a lot of markets, and certainly the repo market, which caused this yield curve inversion. Subsequently, directly after that, we had March 2020, which was, of course, the pandemic crash. Make of that what you will, but we are now in this kind of danger zone. We had the Russian news, and now we're really plummeting. And this is interesting because, wow, US Treasuries are currently printing the lowest ever term prima on our estimates. So the thing is with this is really looking at, people are worried and betting that we're going to enter some sort of a deeper recession than what people are potentially estimating. And you've got to ask yourself, in regards to liquidity, from a bank point of view, it's looking scarce. Not only from a bank point of view, also from a consumer point of view. So people like me and you, retail, you've got to ask yourself the question, bills have nearly doubled. We covered an article that was essentially saying, look, in the UK, because of the increase in bills, they estimate around about 10 million people are not going to be able to pay those bills. Where are they going to get the money to pump into markets? This is a very different environment from March 2020 onwards. And I want to keep stressing this because I really do think that there is cause for concern. Markets right now are trying to climb this wall of worry. We all know that famous scene between Scar and Mufasa in the Lion King, where he's climbing up and then gets thrown off into the stampede. That's kind of how I think things may be looking to shape up with this relief rally. And it is very much a relief rally until proven otherwise. Could we be wrong? Absolutely. We still have around about a 20% allocation of our capital to the cryptocurrency market for that exact reason, just in case we are wrong. Ultimately, I'm a big believer in this space, and I do think it's going to do very well long term. For anybody that isn't already aware, we are going to start doing daily, get them out bright and early in the morning, news updates on the cryptocurrency market. So we're going to try and cover the main headlines over the past 24 hours every single day on this channel in relation to the cryptocurrency market. And some of the big news that we covered this morning was to do with BlackRock getting involved with Coinbase. You also had the likes of Starbucks, Instagram, all these big companies, MasterCard partnering with Binance to further crypto adoption in Argentina and around the rest of the world. You know, the world is moving towards blockchain, but we're in this kind of tough time period, and I think ultimately we're at the mercy of the kind of macro environment. So let's take a little look at where the market is today. It's currently sat at $1.09 trillion, so over $1 trillion, which is great news. At one point we were at 3. We've seen a significant pullback. You should have expected, and we've had one already, rallies to occur. And we have always said, looking at the NASDAQ and looking at this 200 weekly average, that if you were going to get a rally, it was going to occur around about here. You've had that. The issue that you've got is you're now running into a significant neckline of a potential head and shoulders pattern. Very common when you break a neckline or you know, a trend line, call it what you want, that you'll actually come up and retest it. And one thing I want to, and I don't see anybody else really teaching this in regards to trend lines, is trend lines that are like this. Let's not use that actually. So trend lines that are like this, you know, you get the break and it's on volume, they're good. But trend lines that are more vertical or more sort of, horizontal, typically carry a greater degree of momentum behind them. Doesn't mean you don't get the retest and then you go for that further downside. This is what I'm kind of expecting to play out on the NASDAQ. You know, we've looked at prior recessionary periods and how you act going into them. This is essentially where I think we are, this kind of precursor to falling below this going into 2008 and vice versa, the dot-com boom, all related to the Fed upping interest rates, or certainly the dot-com boom was. This is the issue that I have. Remember, your yield curve predicted all these. We're in a similar sort of situation now, guys, in my opinion. And this is why I don't want to be bearish on the cryptocurrency market over the next sort of 3 to 6 months. But I think that a cautious approach is going to serve you far better, and it's something we've been reiterating on this channel, than a bullish one right now. Markets are going to get a bid. You need to look at the fact that if across the board, it's very low liquidity behind this bid. So it's very low, liquidity isn't the right word, volume behind this bid. You know, the big sell pressure, you've not seen this kind of mass volume across the board, not just for crypto, but the equity sector, that would kind of lead you to believe that your big players are getting involved. Typically, I think this is just going to be consistent buying from DTAs, from, you know, you had a short squeeze, you had a number of other things taking place that's really pushing this rally. And for this to be sustained, we need to see that volume come in. I just don't think it's there yet. And this is you're grinding higher rather than hashing out the lows. And ultimately, you know, I do think that further downside is on the table. You know, last but not least, re-mentioning the yield curve, where it's at and what this kind of spells moving forwards. I thought this was a great thread from TED Talks Macro. Commencing in September, the Fed will withdraw up to 2.2 million US dollars out of the market per minute. Bullish USD, bearish risk assets. Quantitative tightening of 2018 was at 50 billion per month, or $1.15 million per minute. That caused the S&P to lose 13.97% of its value over the course of 3 months. From September 2020, the Fed moves at double the pace of 2018. And he's essentially, and we've compared this many, many times, looking at the ES, so the S&P here, and Bitcoin, and really showing you the correlation between them. So he's essentially saying, okay, look, what does this mean for the cryptocurrency market? And this is, people are not pricing this in. They're not pricing, what they're looking at is they're looking at the fact that, okay, well, they're now pricing in a less aggressive interest rate hiking regime. So we can, okay, we priced in a very harsh one. We can maybe add a little bit of that back onto the table, but they're missing things. They're not pricing in risk. That is without even a capitulation event happening, which I think is potentially going to. And this is really, you know, it's a very interesting time to be alive, if nothing else. We do make daily Bitcoin update videos where we sort of speak about the price of Bitcoin, where it's currently at. And for me, you know, it's a really hard one from an intraday trading basis. I'm not going to lie, we've not been doing that well trading it intraday, certainly over the past couple of days, because I don't think the market really knows particularly what it wants. What I do know is that you're putting in a series of lower highs and lower lows here, or sorry, higher highs and higher lows here. So until this is broken and we see some invalidation, that's when we're going to look for the short squeezes to the downside. Do we get there? It's going to be a matter of time. We've got the non-farm payroll coming out today, which is essentially where the Fed look at the labor market. The labor market is really what they're bolstering as a way to sort of say, look, you know, unemployment's very low. We've spoken. Please, for anybody that hasn't watched, go and watch the video that I did with Francis Hunt. Fantastic guy to follow, where he spoke about the unemployment rate, and he spoke about how when that upticks, you will actually get a correlation with markets coming down, and that, you know, there's a correlation there with markets at the high, unemployment is at the low, and vice versa. And I think we're on that kind of unemployment cascade journey, that's going to support our thesis that we see further downside. Could we be wrong? Absolutely, but we're still invested in the crypto space, albeit a small percentage of our overall capital, just for that risk element. Exactly. So that's really all I've got for you guys. I'm really trying to do my best to keep people informed, keep people on the right side of this market. At the end of the day, ask yourself again the question: does the reward outweigh the risk? Does the risk outweigh the reward? If the risk, and I believe it does, outweigh the reward, should you be investing? You shouldn't be totally out of the markets, but certainly you should have that allocation according to your risk reward thesis. All I've got for you in this one, guys. If you enjoyed the content, like as always, appreciate it. So as a comment, and I look forward to catching each and every one of you in the next YouTube video. If you've enjoyed the content, please hit that subscribe button, again, a like and a comment. See you in the next one, guys.